Welcome to Group 3's video presentation. Let's start off by introducing the Bob and builders. We have Ifan, Eva, Sherry, Lynn, and myself, Rin, in the group. And yes, we hope one day when Bob grows up, he can be in the group with us as well. Moving on to our project overview, we'll start off with our research topic, some brief literature review, the model we're going to use, some data description, data analysis, and of course, final stage conclusions. Our research topic. During our initial deliberation, our team has come up with 3 different ideas that could potentially be our research topics. The first one is measuring VIX effects in comparison with USD on Bitcoin prices. Secondly, measuring VIX effects on the stock market index in comparison with VIX on Bitcoin prices. And lastly, the impact of COVID-19 news on the stock markets. After some detailed discussion by listing out the pros and cons, we had a democratic polling through SurveyMonkey, and we have narrowed it down to one, and that is investigating the predicting power of VIX on the prices of top 10 cryptocurrencies by market cap. So why did we choose this particular research topic? There are some interesting findings regarding cryptocurrency. One article shows that cryptocurrencies are being used as a currency of choice for extortionists to deal criminal activities like drug dealing, ransom, tax evasion, and many more. The other important finding is that interest rates can affect cryptocurrency prices because with interest rates, crypto asset holders can loan their crypto assets for interest in return, which would create a whole new market for it. Our research is important because cryptocurrencies are one of the important products of the fintech revolution and a crucial candidate in explaining the US stock market. Market disruption can also spread from cryptocurrencies to traditional assets like gold and commodities. Seeing how cryptocurrency has such ripple effect, it is important to do more research on it. Over to Eva.
Thanks, Ray. Hi, I'm Eva, and I'm going to talk about the literature reviews for our topic. Cryptocurrency are a form of digital currency, which allows online payments to be sent directly from one party to another without going through financial institutions. It quickly became an emerging trend around the world. For instance, Bitcoin's market capitalization has grown rapidly. The price of one Bitcoin started from a few dollars when launched in 2008 and quickly reached 20,000 per Bitcoin in 2017. Other cryptocurrencies also had similar trends which peaked around the same time. The price of cryptocurrency had become highly volatile since June 2017. Many researchers have confirmed the predictability of returns in cryptocurrency markets. The first paper from 2017 shows that volume can predict returns by using nonlinear models. The second paper from 2019 indicates that Bitcoin returns can be predicted by a combination of high-dimension indicators. The third paper suggests that hybrid neural fuzzy models outperform the other computational intelligence models in predicting returns. While many of the findings focus on the return of Bitcoins using different indicators, many had also focused on predicting the volatility of cryptocurrencies. The first paper on this slide shows that volume can predict returns but cannot predict volatility. The second paper from 2018 indicates Bitcoin volatility can be predicted by macroeconomic news surprises. The third paper suggests that there's a significant relationship between leverage effect and future Bitcoin volatility. The last paper found that geopolitical risks can predict Bitcoin prices volatility. Many researchers had suggested the existing predictability of returns and volatility of cryptocurrency. However, does the market volatility have any effects on the returns of cryptocurrency? The CBOE Volatility Index, or VIX, is a real-time market index representing the market's expectation for volatility over the coming 30 days. Our group is specifically interested in the effect of VIX on cryptocurrency price predictions. While the first paper on these slides from 2019 suggests that many variables, including VIX, might not predict Bitcoin returns, the second paper from 2018 shows an opposite conclusion where the S&P 500 realized volatility do have a negative effect on Bitcoin. It is thus up to us to further investigate the effect of VIX on cryptocurrency price prediction. I will now hand it over to Lynn.
Thanks, Eva. Hi, I'm Lynn, and I'm going to talk about the data description. We collected the daily data of the top 10 cryptocurrencies by market cap, which are the following below as shown on the slide. You may see that there's 11 coins here instead of 10. That's because Bitcoin as well was created in late 2018, and its price data was only available after May 2020. This has led us to using Tron, which was the 11th coin by market cap, to replace Bitcoin as well. And we also collected the daily data of CBOE volatility index. The period we use is from January 2nd, 2019 to December the 31st, 2019. And the prices we used are adjusted closing prices. It reflects cryptocurrency's value after accounting for any corporate actions. All of the data was downloaded from Yahoo Finance. Well, after looking into the data sets, we found out that two of our data sets, Ethereum and VIX, have missing values. The missing values of Ethereum datasets are on weekends, and those of VIX datasets are on both on weekends and CBOE expiration holidays. Since the other 9 datasets are complete, we decided to fill in these gaps by using a method called cubic interpolation. The basic idea is to draw smooth curves through a number of data points via a drafting tool. The spline tool consists of weights attached to a flat surface as a point to be connected, and a flexible straight is bent across each of these weights, resulting in a smooth curve. Applying this method to our data, we collected the weekly data of Ethereum and VIX for the same time period mentioned before. Then we created a daily sequence for the weekly range. After that, we use spline function to construct cubic interpolation, and we will end up with complete data sets. As we can see from the 4 diagrams, the 2 above are the original data sets with missing values, and the 2 below are data sets after filling the gaps by using cubic interpolation. The general trends are quite similar, even though the data set after adjusting may lack accuracy because we don't use all the data available. And this could make our data analysis more simple and convenient. And I will pass it up to Sherry.
Thanks, Lynn. Hi, I'm Sherry, and as my teammates have mentioned, we have gone through the process of finalizing our research topic and selecting and obtaining our large datasets, which required a great deal of consideration and collective effort. With the niche yet exciting research area of cryptocurrency and the concept of VIX, which many of us were not familiar with initially, we also evaluated some of the common time series forecasting methods before finalizing our model. Firstly, we rejected the simple average method as it isn't applicable to predict cryptocurrency prices by solely taking the average of past prices, as we observed that the cryptocurrency prices do not obey the law of one price across markets. The second method discussed was a linear trend model, as a trend analysis can be replicated, checked, updated, and refined when necessary. However, historical price data may not draw a true picture of the underlying trend. Also, a major problem in forecasting trends involves identifying turning points. Even with visible turning points, it can be difficult to tell whether they're mere instabilities or the beginning of new trends. Last but not least, the further out one forecasts, the greater the possibility for error, because the passage of time will inevitably introduce new variables. So for one to decide on the appropriate functional form and determine the stationarity of the time series, the key is to examine the autocorrelation functions called ACF. As you can see, Tether and Tron are the 2 cryptocurrencies that reject the null hypothesis of being stationary time series. Therefore, 80% of them are non-stationary. The time series need to undergo the process of differencing to gain stationarity, so we have chosen the ARIMA model in this case. The ARIMA model suits our research purpose as it is used most frequently for hourly or daily data and requires at least 50 and preferably 100 observations to build a proper model. Overall, it suits the characteristics of our price and VIX datasets. We then explore the application of the cubic interpolation model like Lynn mentioned previously. The advantage of the method over the full ARIMA model is that it provides a smooth historical trend, as well as a linear forecast function. The technique is very widely used and performs relatively well in practice. For detailed applications, I'll pass this on to my teammate Ifan.
Hi, I'm Ifan. Thanks, Sherry. I'm going to talk about the data analysis part which explores the predicting effect of VIX on top 10 cryptocurrencies prices using the ARIMA model. Firstly, due to the nature of cryptocurrency, as you can see, for example, the volatility of Bitcoin price has changed over 2011 and 2012. The most of the volatility of the cryptocurrency is unstable over time. Therefore, a log transformation is used here to transform price data to stabilize the variance of the price. Our daily VIX and interim data was collected from first day to last day of 2019. However, our collection of other cryptocurrency prices start from the second day and at the last second day of 2019. So the first and the last row of the estimated VIX and interim data should be dropped. And then we feed all the cryptocurrencies prices into ARIMA model. The ARIMA model of the price is obtained using the auto ARIMA function, which you need to plug in the data into the function. And the main purpose of this function is to select the model with lowest AIC. We firstly estimated the ARIMA model for each cryptocurrency. The 3 legs of ARIMA models for different cryptocurrencies are displayed here in the table. It is worth noticing that for Bitcoin, Bitcoin Cash, XRP, and EOS data, the optimal model is P is equal to 0, D is equal to 1, and Q is equal to 0, which is a random walk process. Therefore, this indicates that the difference the data is a white noise process, which is linearly unpredictable, and it suggests that adding VIX as an exogenous variable into the ARIMA model is not likely to deliver statistically significant results. And the VIX does not have the prediction power for these 4 cryptocurrencies prices. We then add VIX as VIX variables into all optimal ARIMA models of 10 cryptocurrencies. From the table, only the AIC of the interim model, you can see here, has obvious decrease after introducing a new VIX variable. All other are not too different from the original ARIMA model. This suggests that, except for Ethereum, the prediction of other cryptocurrencies prices is not improved by adding VIX variable. Hence, we do not suggest using VIX as a sole predictor for short-term cryptocurrency prices. And the last part is the insights and the conclusion. And this slide shows the limitations from the general econometric analysis point of view. The limitation within the ARIMA model and the interpolation technique may cause inaccuracy in our prediction.
Here are some possible reasons why VIX isn't the best predictor. Many researchers have suggested the uncertainty derived from investor behaviors outperforms the uncertainty of economic fundamentals such as VIX in cryptocurrency prediction. The first paper in the slides suggests EPU, or economic policy uncertainty, can improve the prediction of cryptocurrency. However, the EPU is a newspaper-based index, whereas the VIX is an indicator of 30 days ahead volatility. Many other papers also suggest that the demand of cryptocurrency is more influenced by speculations instead of economic states, since cryptocurrency are mainly used as a speculative investment instead of alternative currency.
And from the market's perspective, cryptocurrency prices are always known to be volatile and unpredictable. And this has even become one of its main characteristics to attract speculative traders. Many have made millions on the big upswings, and yet others have lost large and small investments in the bursting bubbles and sudden market downturns. All investments involve some degree of risk, and we conclude that cryptocurrency trading is one area with particularly high uncertainty. And that is the end of our presentation. Thank you for listening.